You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Welcome to this melting pot of earnings. So I'm trying something different. If you like it, let me know on YouTube, because those podcasts are also reported on YouTube. And the good thing about YouTube is you can actually comment on those. So you can just look at Dividend Guy at YouTube, and you have my channel. I'm making videos, but also I publish my YouTube's my podcast, on those. So let's get started with some utilities. We do have 4 utilities that reported over the past 2 weeks. The first one I want to talk about are Brookfields. So Brookfield Renewable, let's get started with this one. This one doesn't get any love from the market, and that's a shame. Revenue up 22%, but most importantly, FFO per share up 6%. So for a company that is supposed to struggle, that is very tough to in that market, because interest rates are waiting on their debt, higher expenses, and yet they still managed to grow their FFO per share by 6%. The total FFO, actually, funds from operation, was up 9% to $339 million, and management reconfirmed again that they are on track to generate about FFO growth of 10% per year. So very good news over there, and I'm not too sure why the market doesn't like Brookfield at this point, because the numbers keeps on getting good and good and good every single quarter. So hydroelectricity segment, which is about almost 50% of their business, did very well. Strong pricing, especially in North America, and a lot of good generation in Brazil. Wind and solar segment did well also, driven by recent acquisition across North America, Europe, and India. And distributed energy storage also did well this quarter with a combined FFO of $86 million. So long story short, I'm going to hold my shares. I don't really mind about the movement, and because it is a long-term play in my mind. Of course, the hydroelectric power plants are not going to go anywhere. The winds and solar panels are not going to go anywhere either. So I'm fairly confident that this one will eventually get some love, but it's going to take some time. Similar story for Brookfield Infrastructure. Actually, revenue were up 21%, FFO per share up 7%. So a good news overall. Total FFO from operation for Q2 was $608 million, up 10%. So everything looks good here, and this one is sometimes a little bit harder to understand because they do operate in multiple segments. So the utility segment, for example, their FFO was down 20%, mostly because what they do is recycling assets. So they sell assets at a good price, and then they eventually use that money to buy other assets at a lower price. So for the utility segment, they sold some assets, so of course they generate less funds from operation from that segment. However, they actually saw in their transport segment an FFO jump of 60%, bolstered by recent acquisition. So you can see that sometimes they will sell utilities, buy transportation. Sometimes they could sell railroads and then buy pipelines or something like that. So they manage their asset in an active way. Speaking of pipelines, midstream FFO was down 11%, mostly because they had to finance the BIP's U.S. gas pipeline. So when money goes out, it must goes out. And then we have data centers up 8%, driven by more acquisition. And we know that for the data centers, it is a flourishing business. You just can have to think about Equinix that are showing a lot of growth over the past few years. So again, another good place to put a $2 investment. But both Brookfields are not getting much love these days. 2 other utility company reported their earnings, and actually Fortis got some love as of late. So as most utilities, the stock price declined for a while, but as of late, over the past month or two, Fortis is getting a little bit more on the uptrend, which is great. The earnings per share was up 8%, mostly driven by strong earnings in Arizona, reflecting new customer rates as usual. You know, like how it works. Utilities, they will increase their earnings when they increase their rate, or if the weather is on their side. In this case, both happened, so that was a pretty good news for Fortis. They have a reported capital expenditure of 2.3 billion for the first half of 2024. They're right on track to spend their 4.8 billion capital expenditure budget for this year. And for a business that is 99% regulated, just following their CapEx plan kind of makes sense, because when they do that and they're used to negotiate with regulators, they kind of already know how much they will be able to generate from that and the rate increase that will be granted. So long story short, Fortis, very boring company, but it's working. So they just apply the same playbook over and over again with great success. Moving on to the last utility that we're going to talk about today, Capital Power, CPX. This one raised a lot of concern, and it's actually good news this time, because we do have AFFO per share up by 6% at $1.37. The company announced a 6% increase for their dividend, so going from 61 cents and a half to 65 cents and a quarter. Kind of crazy, you know, like 4 digits for a dividend. But the key point here is the dividend increased. The company also revised its annual adjusted EBITDA guidance range to 1.3 billion, between 1.3 to 1.4, driven by lower Alberta power prices and the outage at the Genesis during the first half of the year. The AFFO is expected to be at midpoint of the original guidance. So in other words, not much to say here. It's business as usual. The company continues to do a good job. And as opposed to what happened with Algonquin when they raised their dividend and then reported a catastrophic quarter, Capital Power has most of their debt at fixed rate. And on top of that, they're generating more AFFO per share right now, not less. So those are like two major difference when you compare it to what happened with Algonquin. Now, a revenue going up, but not their earnings, unfortunately. One of my recent acquisition, Toromont Industries, revenue up 16%, but EPS failed to follow, so it would decline by 2%. Not a major decline, mostly related to smaller margin and higher expenses. That could happen from time to time, not the end of the world. The equipment group reported a revenue growth of 15%, and Simco, which is all about refrigerating services, which is really hard for me to say. Sorry, guys. The revenue for Simco was up 19%. Moving forward, Toromont Industries wants to focus on expanding their offer in the equipment group, particularly in the digital solution. So trying to get some technology into those good old large equipment for construction and mining and stuff. More good news coming from Ammon Power Solution, a small cap, high risk, high reward type of play. HPS.A.TO has been on fire for a while, but over the past 2-3 months, it has slowed down. They disappointed last quarter. This time it was pretty good. So revenue was up 14%. EPS was up 77. Kind of crazy, right? So they are enjoying having their new facility, their new factory in Mexico. They're achieving a record all-time high shipment, strong demand for a lot of their products, their dry type transformers. So US and Mexico sales grew by 13%, while Canada sales saw an increase of 23% of sales, which is pretty solid. Again, HPS fascinating company, but it's again highly volatile. You have to be sure that you want to have this type of business in your portfolio. Just have to be very careful when you trade on those kind of businesses, or like put a very small position. I'm going to end on Allied Properties quickly. This one showed an interesting high risk, high reward type of play. The company for a long time kept on generating stronger revenue and stronger FFO per share. That's not the case this time. So the revenue was up 8%, but the FFO per share was down 11%. The payout ratio is now at 94%. So not really great. The occupancy rate is still slowing down, and that is a metric that I've discussed several times on this podcast for Allied Properties, and that's the main source of concern. Now we are at 85.8% for the occupied and 87% for the leased area. So not great. I want to see that going back up over 90%. If not, it's going to be a dud and it's not going to recover. So if you want Allied Properties stock price to recover, they need to show higher occupancy rate, which has not been the case in 24 and not been the case in 23 so far. So definitely a bit disappointing on this one. So right, Moose, I hope that you have enjoyed this melting pot. That was a lot, and I'm actually going over 11 minutes now. So I'm just going to say that I'm just going to wish you a great day, and we're going to talk again tomorrow. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.